Today I'm going to show you how a so-called textbook 0DTE iron butterfly strategy took $10,000 and turned it into negative $5,921.50. That's a total loss of $15,921 with a win rate close to 49% and a single worst trade of negative $8,575. And here's the crazy part. The wings were set using the expected move from VIX1D. The probability of profit matched what the Black-Scholes model predicted, and the break-even levels were 100% accurate. So the math wasn't wrong, the volatility model wasn't wrong, the structure on paper wasn't wrong. The failure came from one missing skill: position management, knowing when to take profit and when to cut loss. Hey everyone, I'm Mike. Welcome back to the ODTE Quant Lab channel. I focus on quant-style ODTE research, real backtests, and strategies that actually have to survive contact with real market data. If you trade iron condors, iron butterflies, or any kind of premium selling strategy, this video is going to reshape how you think about risk, and especially how you think about exits. Let's start with what we actually tested. This backtest uses a very common same-day structure: an at-the-money iron butterfly. Each morning, we sell the ATM call and the ATM put, and then we buy a call and a put at the expected move distance away from the underlying price. So visually, on a payoff diagram, you get that classic tent shape. You've got a little plateau of max profit around the center, then losses on both sides that are capped by the long wings. It looks super clean and controlled, but payoff diagrams don't trade the market. Volatility, gaps, and distribution. So to understand why this thing blew up, we have to walk through the methodology behind it. First, the wings. For every single trading day, the distance of the long call and the long put was set using the market expected move, derived directly from VIX1D, the one-day implied volatility index. The formula is the standard one for same-day options. Expected move equals the underlying price times VIX1D divided by the square root of 250. If VIX1D is low, like 12%, the expected move is smaller and the wings come in closer. If VIX1D spikes 240, 50, 70%, the expected move gets much larger and the wings are placed further away. So this isn't some fixed width butterfly. It's volatility. On calm days, you have a tighter tent. On wild days, you have a wider tent. That's exactly how a lot of professional desks think about structuring these trades. Next, probability of profit, or pop. We didn't guess. We used the Black-Scholes model to estimate the probability that price would finish inside the break-even range at expiration. We calculated two versions. One using a normal distribution assumption, and one using a lognormal distribution, which is more realistic because prices can't go below zero, and upside is ace. The normal pop came out around 44.22%. The lognormal pop came out around 51.90%. The actual win rate from the backtest landed right in between at 48.81%, and the break-even boundaries that Black-Scholes gave us matched the realized outcomes 100% of the time. When the model said this is break-even, that's where the P&L line actually crossed zero. So the pop math checked out, the expected move logic checked out. The model was not lying. Now, here's the key design choice. In this backtest, there were no management rules at all. No early profit taking, no stop loss, no delta hedging, no time-based exits, no volatility filter, no rolling, no adjustments. We simply put the iron butterfly on using those rules and held it straight to expiration. That was intentional. The idea is to isolate how the raw structure behaves without any trader skill layered on top. Now let's look at the numbers. We started with $10,000 of capital. We ran 629 trades. At the end, the equity curve finished at negative $5,921.50. Total P&L minus $15,921.50. The win rate was 48.81%. 307 winners, 322 losers. The average P&L per butterfly was minus $25.31. The median trade was worse, at minus $67.50. The best trade made, $6,368. The worst trade lost $8,575. The max drawdown on paper was almost negative 300%. So almost half the trades were winners. There were some big winners, but the losers were so large that they drowned everything else. This is where a lot of retail traders get trapped. They chase a high win rate. They love seeing green days pile up, but win rate alone is completely meaningless if your loss distribution is toxic. Let's compare a pop to reality again. Normal pop, 44%. Log normal pop, 52%. Actual wins, 49%. Difference, within about 3 percentage points. And price finished in the break-even zone exactly as often as the model suggested. So the strategy did not fail because the probability of profit was miscalculated. It failed because when it didn't work, the losses were allowed to become huge. If we zoom into the P&L distribution, it's classic short gamma behavior. Most of the time, trades are manageable. You have a lot of small winners, a lot of small losers, nothing too dramatic. Then every so often, you get a monster with a minus $8,500 day that completely dominates the average. And here, the truth that a lot of marketing around defined risk spreads conveniently ignores. You are not supposed to take the full max loss on an iron butterfly. On paper, the trade is defined risk. In practice, if you are using too much size and you allow the trade to run to max loss, that defined risk can still be bigger than what your account can realistically handle. In our test, with no management, that's exactly what happened. Price broke out, volatility spiked, the short strikes got steamrolled, and there was no rule in place to say, I'm out, I'm done, take the hit, now before it gets worse. Now add volatility context. During this test, VIX1D had an average around 14.26% and a median around 12.82%. So, most days looked pretty calm, but the maximum VIX1D reading was over 73%. Those are the days where premium sling strategies get absolutely crushed. On those days, a professional trader either sizes way down, gets out quickly, or skips the trade altogether. Our backtest didn't. It treated every day the same. Again, no management. And this leads us to the real edge. The edge in 0DTE trading is not the entry pattern. It's not the payoff diagram. It's not even the volatility model. The real edge is position management. How you take profit and how you cut loss. Think about 3 simple rules that almost every professional uses in some form. Rule number 1, take profit early. Most iron butterfly winners peak relatively quickly. There is no prize for squeezing out every last dollar of max profit. If you take 20 to 40% of the max potential gain and get flat, you dramatically reduce the amount of time you're exposed to tail risk, and your equity curve becomes much smoother. Rule number 2, cut losses early. Don't let price drift to the wings and beyond. Once price clearly breaks the short strikes or volatility explodes, the risk reward of holding changes completely. You exit even if it hurts. You accept a controlled loss today to avoid the catastrophic loss now. A defined risk structure does not mean it's safe to sit and watch it die. It just means you can calculate how bad really bad can be. Your job as a trader is to make sure you almost never experience that number. Rule number 3, keep size small. One trade should never threaten the survival of the account. Tail events are unavoidable. That's part of being short convexity. What you can control is how much of your capital is exposed to that tail on any single day. If we had taken this exact same iron butterfly, blueprint same, expected move wings, same Black-Scholes pop, same entries and simply layered on reasonable profit-taking and stop-loss rules. Along with sane position sizing, the equity curve would look completely different. It might still have drawdowns, but it wouldn't be nooking the account to negative territory. Most traders lose not because their entry ideas are fundamentally bad, but because their exits are undisciplined. They take profits too slowly and take losses too slowly. The backtest you just saw is a textbook example of that dynamic. So, here's the big takeaway I want you to walk away with. The math was right. The volatility input was right. The probability of profit was right. The failure was purely in how the trade was managed. No take profit rules, no stop loss rules, no sizing rules. Entries don't make traders profitable. Exits make traders profitable. If you'd like to see a follow-up where I take this exact structure and rebuild it with real position management, rules things like specific profit, targets, max loss levels, and volatility filters, let me know in the comments by typing. Show me the managed version. I'm Mike. Thanks for watching, and I'll see you in the next one.